Hello traders, Gary Wagner here. It is the 15th day of October 2012, Monday. Approximately 9 a.m. in Honolulu, 3 o'clock in New York, and this is the daily report for gold and silver. Looks like a continuation from last week as we get sharply lower prices today on the heels of China reporting better than expected trade exports and their economy. Currently, we have lower pricing in gold and silver, gold trading off about $16. As you can see, current print on the board, $1737.50. It's had a low of $1727.50 and a high of $1750.10. Silver also down sharply today, off almost 2%, or actually over 2% on the day, down about 75 cents. As you can see, $32.78. Current print on the screen with a low of $32.46 and a high of $33.46. On today's report, we will cover the week ahead of us, what I think we're going to be looking at, as well as talking about a trade that we closed out with tremendous profits, and that would be our silver trade. We'll talk about that all on today's daily report. Traders, we looked at the possibility last week of the potential top, and we've seen and kind of called this top out at 1800 over probably over the last month, but we really needed what I consider to be conclusive, confirming evidence that in fact the top was in place. We really got that on Thursday and Friday of last week. In fact, on a chart which went live on Friday, the title was Correction or Consolidation, and I said I'm absolutely leaning towards correction at this point. You know that Wednesday of last week, I was convinced we probably were really top heavy and at the beginning of a correction. That's why I sent out that special trade alert. Now that this top is really firmly in place, the question becomes what from here? And on Friday, I attempted to take a look at a couple of scenarios. I kind of want to take off from where we left off on Friday's discussion and talk to you about a couple of scenarios. And I want to get in a little bit more detail. I'm going to look at a couple of different charts, but I want to start with this. It's a short-term chart. And the reason that I need to use a short-term chart for this is what we want to do is we want to take a look in terms of the Elliott wave count itself, and not only the major and intermediate, which is kind of where we typically will focus, but in this case, we want to look at the minor count, the count below that, because here's what I'm looking at. When we consider the different Elliott wave counts, I try to think of them really as the layers in an onion or Russian dolls. In other words, layers within layers. And so that when we, for example, take a look at wave 4, corrective wave 4, and that's going to be this wave here, you can see that there's a subcount in there, which is our intermediate count, and then within that is our minor count right in here, 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, 6, 7, and so forth. So that when we now take a look at this major fifth that we're working with right in here, it's going to be composed of those same dynamics. In other words, I believe that this is our intermediate wave 1 right there, and now we're in intermediate 2. Intermediate 2, of course, will take us to our intermediate 3. Now, within these particular waves, there's going to be a subcount, and the subcount's going to be our minor count. And let's go ahead and look at a different chart to get a better handle on that, which is why we spend so much time looking at these shorter term charts, this, of course, being a 360-minute chart. When we take a look at it, we see that we have this large intermediate wave 1 here. And that, of course, can be subdivided usually into a 5 count. And the 5 count might look something like this. 1, 2, 3, 4, and 5. Now, why do I bring that up? Well, I bring that up for the following reason. When we take a look at this market moving down, it's typically going to move down in a similar fashion in terms of a straightforward correction, which would be something like an A, B, and then a C. And by viewing it in that way, The whole idea is for us not to get caught up in the minutia, not to get caught up in the noise, so that when this market is correcting, meaning on a corrective phase, a correction, of course, is going to be to the upside. A correction is always opposite of the current trend, and our minor intermediate trend here is probably going to be down. In other words, we had this impulse up, intermediate. We have the corrective wave 2 down. That's going to be composed of an ABC. This B wave within it, of course, is going to be a move to the upside. And the reason to bring that up is, as we see this market here move back up through our B wave, what I don't want to happen is for us to get thrown off thinking that the correction's over and then it simply comes back and then starts moving south again. We want to be cognizant and aware of the potential that just as a market typically stair steps up, it will stair step down. And of course, the other nice thing is that with wave 1, intermediate 1 in place, it allows us to start using that as a benchmark and taking a look at different models. One of the things that we want to be aware of, and I think is going to be an interesting move in the market, is depending on where this falters for our minor count, meaning our A, once we have some sort of strong sense that that has concluded, this is the minor, our B wave is typically going to be anywhere between 50 and maximum 75% of this move down. You'll get about 50 to 75% of that back. Something tells me that's going to take us right back into this area here, but I'll have to actually do the math to find out. And then what we have is that final C wave down. My sense right now is I don't believe that we'll see more damage inflicted than a 38% retracement. Right now, that's what I feel, and that's taking us to about 1,700. I think it'll be above that. I think 1,700 should hold as support. Traders, now to silver. You know, first of all, our trade is officially over. It is out. We did enter the market at 29.10. Not a bad entry price whatsoever when you consider the way the market moved. That would be right about here. We continually trailed our stops higher, and as those stops got trailed higher, we ended up with our stop being at 33.20, and that's right in this area here. So we were able to, when we consider the absolute range of this last move, and let's look at it from right here because it was sideways up till then. When we take a look at the entire move, we were able to capture at least a third, probably 50, 55% of that overall move. That's not too bad. I don't expect to get in at the bottom. I don't expect to get out at the top. I want as much or as large of a percentage of that move as we can possibly gain. And in fact, I did get letters asking why we didn't get out earlier, why I kept trailing up the stops. And the answer, quite honestly, is because I do not know what the future is going to bring. I have assumptions. In my gut, I believed that we were top heavy and it was coming down. We knew that $35 was resistance that it had trouble overtaking. But the fact of the matter is, one of the reasons we're able to maximize the kind of profits that we do is, one, we take emotion out of the market by putting a stop in the market. We let the market determine what kind of profits we're going to have, as a trailing stop is going to eventually get hit. But what it means is when you have these tremendous runs like we just witnessed in silver, we're able to capture a large component of it. And here's the thing. What if, for example, the market didn't come down and it continues to move up? The fact that I believe it's top heavy isn't going to matter to the market one way or the other. So by trailing the stops up, I will let that determine when we get out of the market. It is a systematic, scientific approach to trading the markets that in all extents takes as much of the possible emotional content out of it, and thereby it, in most cases, I believe, allows us to maximize profits on the trade. Now, what am I looking at and where do I think this market's going to go to and where do I think we're going to reposition ourselves? Just as in gold, if we consider this to be an intermediate count and this is our 1, we are now going to get our 2, and our 2 could take us, it's below here, so it could take us, I believe, to this 50% retracement point that's just below $32 per ounce, and then we'll probably go back to 3 here. Now, another way to look at it is to throw in a Fibonacci retracement just from this point here. Let's go ahead and do that. And as you can see, I've added a couple of our Fibonacci retracement areas. If we take a real quick look at it, I'm starting at really, this was a sideways move. This is why I'm sure that this, at least this portion is our wave 1 right in here. If we take a look at possibilities, this, of course, you want to look at these numbers right in here. But 23 is 33.57, certainly flew right through there. Our next point is a 38% retracement. That's 32.41. That's right in here. And then a 50%, 31.47, 61%, 30.53. Obviously, this is absolutely, in my opinion, the lowest that the market can go to. But what we want to do is we want to look at signs, and we also want to see how gold's trading at these different points. 38, 20, and 31.47. Excuse me, 32.41 and 31.47. This is our 38% retracement level. What we might in fact see is something on the nature of an ABC again. A, B, and then maybe our C like this. So the possible scenarios that we'll see as they unfold are not going to be custom to fit the models that we have. The models that we have to be flexible enough so that as new data comes in, we're able to quickly analyze it and from there strategize the most profitable game plan we can think of and then act upon that. This has been Gary Wagner wishing you as always good trading. We'll talk to you tomorrow on Tuesday for another daily update and review.